This is what happens in the economy. It is what's actually decided at the Monetary Policy Committee. And tonight, that is what we'll be discussing. This will be the current Governor's First MPC, and it will be interesting to see the direction that he and his team, the 7-member committee, will decide to go, whether they will cut rates, a rate hike, or they will decide to stay same. And tonight, we'll be joined by a regular analyst on the show, who is a banking consultant, Dr. Richmond Etuahine, will be joining us to break down this topic. If you are watching us and you're an investor, the most important thing you are looking forward to is Monday to Wednesday. After that 3-day meeting, what will be the decision that the Bank of Ghana will take? Whatever decision they will take will influence inflation, will influence the cost of borrowing, and will influence what comes into your pocket. In fact, bread and butter issues is what we are going to discuss here on the show tonight. And Winston, we were actually discussing that this is the first time Dr. Johnson is, Siama will be sitting with his team. That's a 7-member committee to make that big decision maybe on Wednesday and see what direction the country should go. But in fact, before even they make the decision, there are certain underlying factors that is actually giving the Bank of Ghana some sort of headache.
It's quite interesting. If you look at the mannerism and also how he's come into office, the kind of objective he's set for himself, the kind of team he'll be working with, tells you that he has a lot to deal with. Based on where right now he has not even made any decision yet, so he has to follow on past records, try to adjust certain fundamentals, possibly to fit the objective of where he intends to be. When I talk about the target, there are targets that consistently the central bank has not been able to meet any of its inflation target for the last 8 years. It has not been able to meet any of its policy rates target as well. There's been adjustments to ensure that we meet up with our contractual agreement with the IMF because of the agreements and some of the factors we promised, especially meeting those conditions that we subscribe to as a nation. So going into this, he has to take into consideration the IMF, where the economy intends to be, the cost of living, and whether indeed the government is also ensuring that the price stability will be a key control aspect. Looking at the inflation basket, how it's been, food has been leading for quite some time now. And using food and taking the monetary policy rate, you have to see government also has to do its bit. But the central bank has to ensure the financial sector is robust, resilient, and able to withstand any shock going into the third quarter, possibly second and third quarter of 2025.
So I think it's the best time to bring Doc into this conversation. Doc, this looks like the most consequential policy rate decision that we possibly will ever have in a long time. This is the first of Dr. Johnson Siama. Why is this rate, the 123rd, Monetary Policy Committee, why is it so crucial? And why must we even have such a conversation around where the bank should go at this crucial moment in time, Doc?
Thank you very much, and good evening to your viewers. The reason why it's crucial is that we just had a budget, and they've set the targets and the framework, inflation projection, the fiscal deficit, the arrears and everything. So it's very crucial for I think it's very, very crucial for the governor. Very, very important. Because the inflation expectation by the end of the year, to me, it looks too aggressive, 11.9% at the current space of 23.1. I thought that we would tread cautiously because to come down to 11.19 is a very difficult journey. And as Winston said, we have never, I think we've achieved the target, twice, 8%, 8 plus 2 minus, the target of inflation policy. So if you want to drop from 23.1 to 11.9 within a space of 9 months, I think it's a very, very difficult journey for the governor.
Doc, do you believe that considering the history where we are coming from, especially the challenging aspect of debt management, the banking sector. Right now, the banks are also looking at making profit for shareholders going into the third quarter of this year. The central bank has a responsibility to protect the interests of the banks and ensure that we have a strong financial sector. What decision will likely reflect or protect this bank? Because looking at what they had to undergo during the debt exchange, as well as bringing back investor interest in getting access to capital.
Thank you very much. The governor is going to consider the key financial soundness indicators. And we talk about the asset quality, solvency, profitability, ROI, return on asset, return on equity. We talk about operational efficiency, and we talk about operational efficiency versus the cost. So he's got a myriad of indicators to follow. But the most difficult one currently is the asset, non-asset performing, the asset quality. The asset quality has been deteriorating over the last 5 years, and the last one was 21.8. The governor himself said recently, one of the state banks' asset has jumped from 45 to 62%. And I'm reliably informed that that bank has gone to 72%. So the asset quality possibly will deteriorate maybe 22, 20, 24, 23, as it was in June last year. But apart from that, the profit indicators look good for the foreign banks because they don't have the asset quality that the other 9 banks have. So for them, the profitability look good. Operational efficiency look good. And operational efficiency versus cost income is also good for them. So for the 14 banks, I am convinced and duly convinced that they're going to make a lot of profits and maybe, as we have said already, dividend transfer to their holding companies. But when you come to the domestic banks, I mean the private-owned domestic, including the SOEs, at least the non-performing doesn't look good at all. And some of them, the solvency is also not good. Once your asset quality is not good, it has something to do with your capital adequacy. And unfortunately, there are about 5, 6 banks out of the 9 whose solvency is not very, very good. They are below the accepted level of 13% and the minimum level of 10%.
All local banks?
So, yes. If you take 3 out of the 9, the rest are just struggling, really struggling.
Doc, we'll come back to talk more about the banking sector. Now, I want to take you to the smart wall and show you a graph, and we'll pick your view on that. Winston, this is the governor who will be chairing the 7-member committee, and they will be making that important decision after their 3-day meeting, and that will influence the direction that the Ghanaian economy will take. But it is always good to learn from history. So let's go back and look at how the trend has looked like so far. In fact, this reminds me of some of the curves we used to see in the classroom, right? But it isn't just a curve. It tests the pulse of the Ghanaian economy. And the last time we even drew a certain interesting correlation between monetary policy rate and the outcome of presidential election. And we saw that interesting correlation there. What we see is that the longest maintenance in terms of the rates that we've seen in this period under review from post somewhat 2019 to 2025 was during COVID, where the bank decided to maintain the rates a lot of times. But right after we had our hits in 2022 and 2023, we've seen the rates going up significantly. And this year, for instance, we've seen maybe the last quarter of 2024, and we've seen the maintenance of maintaining the rate. You decided to stay with the same rate, 27%. But let's look at what we are seeing here. The direction for me is important, Winston, and the red directions there. What direction is the bank actually going? Whether are they going up in terms of, are they going to hike rate, going straight, maintaining rate, or deciding to cut rates in the long run? I mean, that will be an interesting something to analyze when they finally do that. But this, for me, is what is catching everybody's attention, right? I will be picking Doc's thoughts on it, but I want to start with you first. This is the policy rate, 27%, the current policy rate. Inflation is around 23.1%. Treasury bills, 91-day, 15.3. What sort of imbalance are we seeing here? I mean, they should have some sort of correlation, right? And they should be at par a bit. But we are seeing huge differences. What is really happening, Winston?
Some would say magics, miracles, signs and wonders. This is what we're seeing here. Policy rate inflation is very important. We've consistently been advocating. We've had the Institute of Economic Affairs hitting on the fact that there should be a review of how we determine inflation using the policy rate. They've been hitting on that, and also they've been advocating for a fiscal council to ensure debt fiscal consolidation management, especially looking at our debt structure, is also reviewed. And when that is done, possibly the fiscal council can determine within a period how much government can borrow from domestic market, therefore managing the government's debt structure, because government cannot just wake up and say, I want to borrow, but they have to consider how it will impact on the economy. And looking at this, it tells you that sometimes the inflation can tend to behave how it wants to behave if prices keep going up, especially the various commodities within the inflation basket. Right now, we are at 23.1%. Thank God we were as high as 54%. This is good if you look at how much purchasing power is being derailed. However, looking at where we are, it's quite too soon. I project that surely inflation will go down. Looking at the current rainfall season we are experiencing in the first part of these last 2 weeks, and we are hoping that it will reflect.
You expect food inflation to come down, right?
Yeah, I expect food inflation to come down in key regions, looking at the rainfall pattern, because the drought in the northern region is being marginally handled, and I believe we've not yet seen the full implementation of government's policy on key strategic agriculture-related aspects, especially food. All we've seen is some steps being taken on the Nkukwo-Nkiti project, where the seedlings chicks have been given to some organizations such as the YEA to ensure its implementation. But it will reflect based on the cost of X subsequently, and we'll see the outcome of it. But the T-bill rate, which is at 15.3%, is going to be quite disturbing. And it puts the central bank in a very tight corner. Very tight corner. Looking at how much businesses will be able to have access to this capital. Banks will feel comfortable now giving their monies to businesses, because with that, they can have a stable return compared to holding on to it till it keeps dropping, which they may not have need for that money. Banks' main job or main business is selling money and buying money. At this time, it's best to give out money so that the money can be at the rate where they can make profit, compared to holding on to it. Still seeing the rate go down, it will affect their profitability going forward.
I mean, what we were taught in basic economics is that there is actually some sort of relationship between treasury bills, monetary policy, and inflation. Once you have inflation very high, if you want to bring inflation down, you hike the rate to bring inflation. And when the monetary policy rate is going up, you expect T-bill rate to also go up.
Yeah.
But this time around, what we are seeing is that the demand and supply forces, the demand is usually from government, and government has been able to shrink its demand to the extent that you have supply available, demand very few. What that means is that it drives the price down, the interest rate in the treasury bill market down. But when the treasury bills begin to move from 28% to 15.3%,
yes,
what the market, or maybe what the government is telling the central bank is that, look, maybe it's time for you to reduce your monetary policy rate. But the Bank of Ghana may be having big headaches and saying that it is not time. We still feel that we've not consolidated our gains yet in the inflation space. If we decide to bring the rate down right now, what we are possibly going to see the cedi losing value and inflation coming up. I want to pick Doc's thoughts on this. Doc, I mean, what should we expect? Usually, we should see monetary policy rate coming down before treasury bills will possibly come down. But it looks like government has decided to reduce a demand for T-bills, and that is pushing the rate down, forcing the Bank of Ghana to maybe come with a premature rate cut. What do you have to say about this?
Well, thank you very much again. I think if you look at what has happened, the intervention the intervention by government that has forcibly brought the rate down. That is a direct intervention. But if you look at the policy rate, the inflation expectation, I don't think Winston said that to drive it down. The expectation is very high because if you look at the environment, the macroeconomic environment now, it is not as good as people think. Any country that have more than 20% inflation, and if it has been consistently over the last 1 year, we call it hyperinflation. There is a literature there. So the governor will be very, very circumspect about bringing the rate down just because the treasury bill rates have been forced down. If he doesn't take care and he decides to go along that path, inflation will get out of control. So the policy rate may not change drastically or may be maintained, like Dr. Kwache has said. Looking at the environment, it is very, very difficult. I heard him saying that it is raining. That rain is not going to turn into food until September and March or earlier in May. So we're talking about a current thing. And the city has not been very, very firm or stable over the last 1 month because it has jumped from 1585 to 1615. It's a long jump. So I believe that to keep things at least stable, I would advise that he will stay where he is at the moment and see the outcome for the next 2 months, where he himself will be very convinced about the macroeconomic environment, including stable inflation, stable currency, lower inflation. But if he should preempt it and do it as if he's being directed, because it is the policy rate that sets all the rate, interbank rate, treasury bill rate,
the Ghana reference rate, average lending rate,
and that is how the literature has been all this while. But we have now come to a situation whereby government, the fiscal, is trying to say that, look, we want to calm it down. We want to bring the treasury bills down. But we are not thinking about inflation. And you cannot run an economy without a stable inflation or lower inflation and a stable currency. So my best bet, if I was to be, I'm not a betting person, but my best guess would be either you maintain it 27 or just lower it by 0.50 to 26.50 so that it will look something not as you're being driven, but the expectations are not good. The inflation expectations are not good at all.
Doc, fortunately, the betting tax is about to be cancelled. Like if you had bet, it would have taxed you on that. All right, Doc, at this point, it appears with what you just said, now that you're saying the central banks should be more cautious. In being cautious, government also has the tendency or the objective, the central bank, to ensure price stability. What is the risks associated with that angle? Certainly, should they decide to go by the policy rate as against price stability? And we know how sometimes the policy rate can be adjusted. However, when you go to the market, the inflation is quite different from what we hear.
Because, you see, globally, and ever since we started this inflation target in 2007, the measure is the main variable that we use in talking about the rates. So it looks like this one is outlier. This treasury bill is very, very outlier. It doesn't fall into within it. So it makes it very difficult for the governor. And I don't want to wear his shoes at all. Because if he leaves it where it is, people will say that, oh, you don't want businesses to get more money or be able to lending to go down. But if you take your glasses and lenses very well and look at what is going on, I would advise the variables doesn't look good. And other people have said it. I mean, let me quote IE Dr. John Kwache. He said it this morning that the environment doesn't look good for dropping the inflation. The expectation is a bit, he's not comfortable about it. And the same thing applies to me. I don't think I'm very comfortable with inflation until I see the drop between maybe 20, if you can get it 20 they now begin to think about dropping the policy rate to say 25 or 24, so that you always have to keep that margin. Otherwise, we'll find ourselves in a situation whereby some rates are going down and some rates are staying where it is. And it's not good. You know, we don't do synchronizing all the rates, at least to make the private sector, give them the ability to borrow at a lower rate. And it is only done when you use the policy rate to get the inflation down. All the other rates will follow by itself.
Now, Winston, I think we should go back to the screen. Doc was talking about outliers, and this is definitely an outlier if you compare it to what happened in 2019 when we had a very stable economy. Just look at it. Look at how the policy rates and inflation, they were actually moving hand in hand. 16%, 15.1%, although not the same, but I mean, the difference there wasn't big. It was very marginal.
And this year was
marginal, very small. Look at where inflation was, 9.5. At this point, any businessman will be happy to buy T-bills because, I mean, your returns is actually higher than the inflation. This is what happened in 2019. 2019, this is what actually happened. But what we are seeing this year, let's go back to, this year's, graph that we are seeing in red, and you can see the difference there.
Yeah.
Just look at where Treasury bills, the rate is, and policy rate. I don't know what is happening in this space, Winston.
So it makes investments or basket of investment risks invest, if I should put it that way. Because if you decide to invest in any instrument, you look at inflation. Right now, all the investment options are not quite available. We were quite conversant about the central bank decision to go into gold coin. Yes.
Let's talk about the gold coin.
Exactly.
An alternative.
As an alternative investment option. So this one thing that we got to understand was that it provides a stable commodity in terms of price stability, and also the assurance that possibly it could go up, looking at how the gold market has been bounced for quite some time now. So if that should be an option, but the key issue is every instrument needs kind of education to ensure investors or customers understand what they are putting their money into. And that will take time before people grasp into it, considering how much many have lost due to the misunderstanding or less application of the domestic debt exchange program. And we understood the PR that went negatively against the government during those periods. However, with this that we have now, it makes it quite tight to roll out any investment. Currently, we had the pension regulators or pension fund managers asking for a review to ensure that they can now invest some of their pension monies in foreign investment schemes, because they have said they have the money, but they are limited in where to invest it, and that is a key issue. Another school of thought is also saying that why wouldn't government open its options, because there are huge funds available that they can borrow from and make negotiations instead of just relying on the T-bill market. So this time takes a lot of financial decision, strategies, and we have to change how we used to do things. Right. It's not the same way as we face it, looking at our current economic situation.
Well, if you go elsewhere, maybe in the US, you see how some of these indicators work hand in hand. But yes. It looks like because of our structural problems, we don't really see the importance or the benefits of some of these decisions, right? Where you can have T-bill rates going down, but monetary policy rate is still very high, inflation is still very, very high. It tells you the kind of imbalances we have in our system and the gaps we have in our system. Of course, I understand the private sector if they are expecting the governor to cut the rate, because I mean, they've been in the negative for a long time. Government has been competing with them with very high rates. In fact, if you go to the bank and you wanted to lend, let's say a year ago or 2 years ago, it would have been difficult for you as a private person
to have access compared to government.
Yeah. And I understand if they are expecting a rate cut, right? And they are expecting it now. But I would also agree with Dr. Richmond Etia, who says that, I mean, nobody wants to be in the shoes of the governor at the moment and the 6 other, members of the committee, because you have to not like please everybody, but weigh the each the side of the coin equally and make a decision, which I don't know what is your decision, but per the analysis we've had so far and the data that I have seen, and in fact elsewhere, it's not just about inflation. If you go to the US, for instance, even the rate of employment, the employment condition, unemployment rate determines the direction that the Fed will decide to go. And I looked at the last MPC report, and you can see that, you know, job applications and job postings, and in fact, those who are even contributing to Social Security has gone up, but it is not as big as maybe we wanted, right? And so I am, possibly predicting or saying that the rate should stay the same. How about you?
I think it may go down by about 200 basis points.
200 basis points, that's wild. Doc, do you agree with Winston?
Well,
last comment.
Winston is a very good forecaster, and what he's got, I hasn't got it, so I can't blame him. But where I am sitting, I'll tread cautiously that I'll just maintain it, at least for my first 2 months as a governor and the board. I would like to maintain it as it is, and then wait for the next 2 months and see what goes on, including global shocks.
All right.
Because we even factor the global shocks. If you factor the global shocks, you may think that all is well with you here, so you can drop it. But suddenly you get up in the morning and the oil prices have shot up or going up, or gas are going up, you're going to have a problem.
Thank you very much, Doc. Well, I mean, Doc is saying stay. I'm also saying stay. But Winston is very confident that private sector must enjoy now. So, Governor, 200 basis point cut. This has been Beyond the Numbers with me, Isaac Ofeje. And I always do this with...
My name is Winston Taki. Expect more amazing analysis here, hopefully on Wednesday at 2 p.m. We're coming away Wednesday, 2 p.m. Fridays at 5:30. Don't miss it. Enjoy the rest of our programs here on the Journey's channel. Have a fantastic weekend. Stay safe.
Where are you going this weekend?
Let's go and
stay home.